So some of the things that we need to consider when looking at income protections are: what is the definition of incapacity and what does it cover? How long the deferred period is, whether there's any proportionate or rehabilitation benefits to be included, whether the plan needs to be indexed to make it relevant in future years for inflation, and other additional benefits that you can particularly add on. So we're going to wade our way through these one at a time and look at the different each cheese in isolation and what it really means for our income protection plans. So what about definition of incapacity? Well, insurance companies have different definitions, as you can probably imagine, and you will need to pick a plan that meets your needs really, and making sure the plan covers essentially everything you need it to. And I think it's fair to say that the more the plan covers, the greater the likely premium, and I think that's a natural situation to find ourselves in. And the looser the definition of incapacity, the cheaper the policy is likely to be. So there's 4 incapacity definitions we're going to look at: own occupation, suited occupation, any occupation, and homemaker, home person cover. So let's have a look at those 4 different categories on the next slide. So own occupation is essentially the one that most policies default to, and this basically says that if you can't do your own job, then you should be able to claim. So the definition of incapacity is can you do the actual job that you do right now? So it's the widest definition essentially. They cannot make you on an own occupation plan take up other work that's perhaps you could do, but it's not quite in keeping with what you would normally do. That essentially is suited occupational policies. So own occupation is straightforward. Can you do the actual job that you're employed to do? Yes or no? If you can't, then potentially you can claim. Suited occupation, going on from what we've just been mentioning there, is where they may, or the insurance company can, essentially say we're not paying out because you could go and do that job there, let's say, a suited occupation. So maybe you're a mortgage advisor that drives around and sees people in the workplace. You break your leg, you can't drive. So you can't actually do your own job. A suited occupation might turn around and say, well, I noticed that you also do mortgages over the telephone. Maybe you can go and do that, and we're not paying out because you can go and do that. That's essentially is suited occupation. So they can refuse a claim if the insured could still do a job that they're trained to do, just not the actual job that they actually do. Any occupation is essentially the loosest of the lot, and this basically says you can't work. So in order to be able to be able to put in a claim, you're unable to do any occupation, any work, totally unable to work. So essentially that's the cheapest plan of any. And everybody gets this confused because they think that any occupation's got to be the best cover. It's not. It's the worst cover. Own occupation is the best cover. Homemaker, home person, house person cover essentially is where you've got no income and you can insure up to certain levels, and you'll be tested against your ability to fulfill certain activities of daily living. Very, very rare in the current market that you get house persons cover, and you'll be very, very unfortunate to see anything in your exam on it. So deferred periods then, what do we mean by deferred periods? Well, it's the waiting period during which you're not going to be paid any benefits. So it's essentially, for the employed, it's certainly going to be tied in with the sick pay they receive for their employer. So it can be 100% for 3 months and 50% for the next 3 months. Let's say that you're paid from your employer. You would want your deferred period of your plan to pay nothing in that case for 3 months, then to pay you half pay for another 3 months, and then to kick in and pay all of your pay up to the maximum allowable after that period of time. So the deferred period is essentially the one that you need to make sure you don't breach, because you cannot be paid by your wages and by your insurers. That's not legally allowed. So your deferred period can also be driven by budget, because the longer your deferred period, the more that you contribute yourself, the cheaper the plan's going to be. And the typical deferred periods that you'll see in these plans are either 4, 8, 12, 26 weeks, 52, even 104 weeks in some cases. The longer the deferred period, as we've said, the cheaper the plan becomes. So essentially, you will need to consider this, make sure you understand fully what your actual employer is providing for you, and arrange a plan according. So what are proportionate benefits then, and how do these work? Well, most insurance companies will offer this as an option with your plan. Essentially, it's a top up if someone returns to work in a different capacity. So let's say you're a manual worker, you're unable to return and do your own job, but you can return and do a lower paid clerical job. Essentially, what that means is that a life assurance, an income protection plan may well make up the difference or make up part of the difference. So the whole idea of proportionate benefits is to encourage people back to work rather than sitting there thinking they're better off whilst being on sick, rather than taking a lower paid job. It's a common feature nowadays on income protection policies, and your income that's often used in the calculation of your benefits is normally an average of your earnings pre-incapacity over a certain period of time. Rehabilitation benefits. So this again is a type of top-up, and this is when you return to the work in the same capacity but perhaps on reduced hours. So maybe you go back and do your own job on a part-time basis, again designed to encourage people back into work, so that actually they're better off essentially by working a bit and being covered by insurance a bit than they would be essentially by staying at home and claiming the insurance really. The benefits are realigned to the ratio of your revised earnings, as you would expect, and it's a common feature that you expect to see on most income protection policies nowadays. So we're going to look at increase options now, which is a very popular feature that people would add on to their income protection plan. Essentially allowing you to inflation proof your benefits in future years. You would expect your wages would increase. So you'd also want your potential cover to increase in line with that. So this allows for increases in line with inflation linked to one of the inflation indexes, or potentially by a set amount each year. And it's designed to keep your sum assured really in line with your salary. So you need to be careful a little bit here to make sure that the indexation doesn't extend beyond the maximums allowable. But generally you will add this on. You'll see the benefits increase. Your premiums will go up each year by the same proportion, and there's no further underwriting required. So you won't need to go and have a medical every year or reapply every year for the higher amount of sum assured, and it's going to happen automatically. You can also have guaranteed insurability in certain aspects with IPPs. So ad hoc increases if you get married, you change job, you have a new baby, all those sorts of things potentially may be triggers for you to be able to have an extended amount of insurance, subject to the maximums of course, and you won't need to do further underwriting on those either. So let's look at some of the ancillary benefits that you sometimes get tagged on to income protection plans. And these are becoming more and more popular actually, with policies starting to think about the way that they can get people back to work quicker, and of course pay you less really by way of benefit. So lots of policies now will include things like counselling, cognitive behavioural therapy for those of people that are suffering from certain mental conditions, medical rehabilitation, so the likes of physio and all that sort of stuff can actually be included. It has been known as well for insurers to pay for minor operations, minor surgeries as well, with a view to getting people privately treated and not wait for the NHS to call on you. And that, of course, can reduce the amount of time that you are sitting around waiting for your operation and claiming on your insurance. So almost all now will have some kind of medical helpline support service available within the nature of the actual insurance policy that you've bought. Some also have certain financial benefits built into them, including things like hospital plans, whereby you'll be paid a certain amount if you spend nights in hospital. And also certain policies have other financial benefits enabling you to change your workplace in the event of disability and claim to get special chairs in or special screens, filters, or whatever the case may be for your workplace. Also, there's a consideration for waiver of premium. Now, effectively, waiver of premium is included in the vast majority of plans. And what I mean by that is if you're claiming on your insurance, you don't tend to need to pay premiums. It's automatically insured, so to speak, for this. But not all plans work this way. So you might want to know that you can definitely keep your plan going in the longer term, even if you're off work and you're not paying the premiums. So it's essentially an income protection plan for your income protection plan. Who knew? So they essentially offer all the same options as a standard income protection plan, e.g. your deferral payment periods, etc. As I've said, the vast majority can see the nature of this being a little bit contrived and will throw this in automatically, that when you're claiming, you don't need to pay your premiums.